Okay, we're going to start on problem 17-4B, looking at the 19 measures of solvency and profitability. The comparative financial statements of Stargell Inc. are as follows. The market price of Stargell Inc. common stock was $119.70 on December 31st. And then gives us the comparative retained earnings statement 2013-2014. Top of the next page, we have the income statement 13 and 14. We have the balance sheet of 13 and 14. And our instructions tell us to determine the following measures for 2014, rounding to one decimal place, except per share amounts which should be rounded to the nearest penny. And then it lists the 19 different measures. If we look at our worksheet, if we look at our working papers, it tells us, it gives us a really nice setup. Our numerator, which is the number at the top, and our denominator, which is the number at the bottom, and then our calculated value. Another thing that you might want to grab that will really help you a lot is in your textbook on page 800, or for those of you using the online textbook, it's Exhibit 10 out of Chapter 17. And this tells us exactly how to compute every single one of these ratios. So we're going to start with number one, and number one is working capital. And if we look at our figure that's in our book, it says working capital is current assets minus current liabilities. Okay, current assets minus current liabilities. So we are going to come over to our textbook, and we're going to find our current assets for 2014. It says total current assets, and for 2014 it's $3,690,000. So we're going to write that at the top here. $3,690,000. Now, because this one isn't a ratio, they gave us a line at the top to do it on. And we're going to subtract our current liabilities. So back to our balance sheet. And our balance sheet tells us that our current liabilities were $900,000. So we subtract the $900,000. And we get a working capital of $2,790,000. Okay. The next one is the current ratio. And our textbook tells us that to find our current ratio, we're going to use current assets divided by current liabilities. Well, we just looked up our current assets and current liabilities, so we can just pull these numbers down here. So we're going to take $3,690,000 and divide it by 900,000. So once we do that, we find out that it is a ratio of 4.1. The next one is a quick ratio. A quick ratio, and if we look in our chart here, a quick ratio tells us it's our quick assets divided by our current our current liabilities. Our quick assets divided by our current liabilities. Well, we know that our current liabilities are $900,000, so we can go ahead and fill that number in. And then we need to calculate what our quick assets are. We're going to calculate our quick assets, and our quick assets are going to include our cash, our marketable securities, and our accounts receivable. Remember, a quick asset is something that we can change into cash very quickly. So we're going to take these three numbers and add them together. I'm going to grab a piece of scrap paper, and we have $500,000, $1,010,000, and $740,000. We're going to add those three numbers together, and we get $2,250,000. And these are our quick assets, so that becomes our numerator. That becomes the number at the top of our. So we're going to take $2,250,000 divided by 900,000, and we get 2.5. Now the next one is the accounts receivable turnover. And in our note sheet, the accounts receivable turnover is our net sales divided by our average accounts receivable. So we have some calculating to do here. First thing we're going to do is try to find our net sales. So if we look at our income statement at the top, it tells us that our net sales for 2014 were $10 million. So we're going to come over to our worksheet, and that becomes our numerator. Okay. Now our denominator was average accounts receivable. Average accounts receivable. So we're going to go to our balance sheet and find our accounts receivable. Accounts receivable was $740 in 2014 and $510 in 2013. So we need to average those out. So in our denominator, I'm going to grab my scrap paper here and do this here. I'm going to take the 740 plus the 510 and I get 1,250,000, and to find the average of something, you divide it by 2. And we get 625,000. Okay. Again, this is our AR in 2014. This is our AR in 2013. And this gives us our average accounts receivable. Okay. So that 625,000 becomes our denominator. Again, we're going to divide these numbers. And when we do that, we get accounts receivable turnover of 16.0. Okay. Number 5, the number of days sales in receivables. If we look at our note sheet, number of days sales of receivables is our average accounts receivable, which we've just calculated in the previous one, divided by our average daily sales. So we know that our average accounts receivable is $625,000. Our average daily sales, well, we know that our sales for the year were $10 million. So I'm going to come back down to my scrap paper, and I'm going to take my 10 million, and I'm going to divide it by 365 days. And that will tell me what my daily sales were. And that comes out to be $27,397.30. Okay, so this gives me my daily sales. So that becomes my denominator, $27,397.30. So I'm going to divide these numbers out, and we get 22.8. Okay, number 6, wants inventory turnover. Our inventory turnover is cost of goods sold divided by our average inventory. Cost of goods sold divided by our average inventory. So we're going to come back over here to our income statement in our book. Cost of goods sold, our book tells us, was $5,350,000. So that's going to be our numerator. And our denominator is our average inventory. So we're going to come over here to our balance sheet and find our inventory. And it tells us that our 2014 inventory was $1,190,000 and our 2013 was $950,000. So I'm going to take my scrap paper here. I'm going to take those two numbers, 1,190,000 plus the 950,000 of 2013 and I get 2,140,000, and I'm going to divide that by 2 to find the average. And we get $1,070,000. So this is my average inventory, so that becomes my denominator. Oops, sorry about that. And again, I'm going to divide these out. and we get 5.0. Okay, number 7 is number of days sales in inventory. So look at my note sheet and it tells me that number of days sales is my average inventory, which I just calculated, divided by my average daily cost of goods sold. Okay. Well, we know that our average inventory is $1,070,000. We just calculated that. Now we need to find our average daily cost of goods sold. So we're going to come back to our income statement. My cost of goods sold was $5,350,000. So I'm going to take that number, again back on my scrap paper here, $5,350,000, and I'm going to divide it by 365 days. And I get $14,657.50. So this becomes my denominator. Okay, again dividing these numbers out, and we come up with 73.0. Now, ratio of fixed assets to long-term liabilities. Ratio of fixed assets to long-term liabilities. So I come up to my note sheet. Ratio of fixed assets to long-term liabilities are fixed assets divided by long-term liabilities. Fixed assets divided by long-term liabilities. So I'm going to come over into my textbook to my balance sheet, to my assets section, and I want to find what are my fixed assets. And fixed assets are things like property, plant, and equipment. And it tells me that they are $3,740,000. So that's what my numerator is going to be, $3,740,000. And we said that this was divided by our long-term liabilities. So we come back to our textbook and it tells us that our total long-term liabilities were $1,700,000. And that becomes my denominator. Dividing these two numbers, we get 2.2 as our ratio. Okay, number 9 is the ratio of liabilities to stockholders' equity. So we look in our note sheet and it tells us that that is our total liabilities divided by our total stockholders' equity. So back to our balance sheet, and we find out that our total liabilities were $2,600,000. So that's going to be our numerator. And our total stockholders' equity was $7,180,000. So then that becomes our denominator. Okay, again dividing these out, and we get 0.4. Okay, number 10, number of times interest charges are earned. The number of times interest charges are earned. This gives us our income before tax plus our interest expense divided by our interest expense. Okay, so our income before taxes, we're going to go to our income statement. Income before taxes was $1,130,000. So we're going to, back on our scrap paper here, $1,130,000. We're going to add to that our interest expense, which we can also find from our income statement. It says other expenses interest was $170,000. So we're going to add to that our $170,000. And we get $1,300,000. So that becomes our numerator. And then it said our denominator was our interest expense, which we know was $170,000 because we just looked it up. We're going to divide those two numbers out, and you get 7.6. Okay, number 11, the number of times preferred dividends are earned. The number of times preferred dividends are earned, and that is our net income, our net income divided by our preferred dividends. Net income divided by preferred dividends. So on our income statement, it tells us that our net income was $900,000. So that becomes our top number. And then we need to know what our preferred dividends were. And for that number, we're going to go back a page. And it tells us that deduct dividends on preferred stock, our preferred dividends were $45,000. So that becomes our denominator. Again, dividing these two numbers out, and we get 20. Okay, number 12, ratio of net sales to assets. Ratio of net sales to assets. Now we're getting into our profitability measures. Ratio of net sales to assets is net sales, divided by the average total assets excluding long-term investments. Okay, net sales divided by the average total assets excluding long-term investments. Well, let's first start with our net sales. Going back to our income statement, our net sales can be found towards the top, and our net sales were $10 million. So that's going to be our top number. Okay, I'm going to grab my scrap paper here. Our bottom number is our average total assets, excluding long-term investments. So going on to our balance sheet, we are going to look at our total assets, our $9,780. However, they want excluding our long-term investments. So we're going to take that $9,780 minus our long-term investments of $2,350. Minus $2,350. And we get $7,430,000. Now we have to do the exact same thing for our 2013 numbers. And in 2013 we had $87.55 minus our long-term investments of $2,300. Okay, so we're going to subtract these two out. And we get $6,455,000. Now it says our average total assets, so we have to average these two out, so we're going to add them together. And then divide by 2 because it wants the average. And we get $6,942,500. So this number becomes our denominator because that is our average excluding long-term investments. $6,942,500. Okay, again we're going to divide these two numbers out and we get 1.4. Okay, the next one, ratio earned on total assets. Ratio earned on total assets. Our note sheet tells us it's our net income plus the interest expense. divided by the average total assets. Now this average total assets does not say excluding long-term investments, so we will have to calculate that number again. But let's start with the top one. The first one wants our net income, which is $900,000. We find that on our income statement, plus our interest expense, which we found out before was $170,000. So I'm going to go to my scrap paper and go 900,000 plus the 170,000. Yeah, I thought I put that in the wrong spot. And I get 1,070,000. Okay. And then again, the bottom one is average total assets. So coming back to our balance sheet, we're going to be using these two bottom numbers of our total assets, 9780 and 8755. We're going to add them together. And we get 18,535,000, and then divided by 2, because we need their average. And we get 9,262,500. And that number comes up here. Okay, again, we're going to divide these out. And we get 11.5. Now this one is expressed in a percentage. Okay, ratio earned on stockholders' equity. The ratio earned on stockholders' equity. So ratio earned on stockholders' equity is our net income divided by our average total stockholders' equity. Okay. If we look at our income statement, we find that our net income was $900,000. So we can just stick that in there. We're dividing that by our average stockholders' equity. So we go to our balance sheet and we find that our total stockholders' equity in 2014 was $71.80, in 2013 was $63.75. So back to our scrap paper. We had 71.80 plus 63.75. And then divide it by 2 to find the average. And we get 6,777,500. And that gives us our average total stockholders' equity. So then that number goes here. And we divide those two out and we get 13.3. And that one is also expressed in a percentage. Okay, the next one is the rate earned on common stockholders' equity. So the rate earned on common stockholders' equity is net income minus preferred dividends divided by the average common stockholders' equity. Net income minus preferred dividends divided by the average common stockholders' equity. Well, we know from the previous one that our net income is $900,000. And we're going to subtract from that our preferred dividends. And if we flip back a page in our books, it tells us that our preferred dividends on preferred stock, were $45,000. So subtract 45,000. And we get $855. So that number goes here. Our bottom number was the average common stockholders' equity. To find our average common stockholders' equity, we're going to go to our balance sheet. In the stockholders' equity section, we're going to take the retained earnings of $61.80 plus the $500 of common stock, which gives us $66.80. So we'll start with that number. And we're going to add to that our 2013 numbers, which were $53.75 plus our $500 of common stock, which gives us $58.75. Oops. We'll add those together. And we get $12,555,000, and of course we're going to be dividing that by 2 because we want the average. And we get $6,277,500. And that becomes our bottom number. We're going to divide these two numbers out. And we get 13.6%. Okay, the next one is earnings per share on common stock. Our earnings per share is calculated by taking our net income minus preferred dividends, which we did in the previous problem as well, divided by the shares of common stock outstanding. Okay, so we know that our top number is 855 because we just did that in the previous problem. And then we need to figure out what our common shares outstanding are. When we look back at our textbook, it tells us under stockholders' equity that their common stock is $5 par and there's $500,000. So if we divide that out, $500,000 divided by $5 par, we get $100,000. And that becomes our denominator. Now, when we divide these two numbers, we get $8.55, which is our earnings per share. Okay, the next one is the price-earnings ratio. The price-earnings ratio is found by taking the market price per share of common stock divided by earnings per share on common stock. If we look in our textbook, the very first paragraph told us that the market price was $119.70. So that gives us our top number. And then our bottom number is the earnings per share on common stock, which is the number that we calculated up above, and that was $8.55. Okay, we're going to divide these two numbers out, and we get 14. Oops, only 1 0, sorry about that. Okay, the next one is dividends per share of common stock. And our textbook, or our note sheet, tells us that it's dividends on common stock divided by the shares of common stock outstanding. If we look in our textbook, on the retained earnings statement, it tells us that our dividends on common stock are $50,000. So that's our top number. We calculated our shares outstanding up here, so that becomes our bottom number. Divide them and you get 50 cents. Okay, our last ratio is dividend yield. Our note sheet states dividends per share on common stock, which we just calculated, divided by the market share on common stock, which our textbook tells us. So we're going to take our 50 cents divided by our $119.70, and we get 0.4%. Now, when you do your assignment problem, please be sure to also scan in your math sheets. I don't want to see just the numbers on your worksheet. I want to see how you got those numbers. At this point, you can turn off your video and head back to your PowerPoint.